Good afternoon, everyone. So as Nicola's mentioned, oops, let me just change this because my display settings are going a bit weird. There we go. I'm Paul. I'm the head of sales for obviously West One Buy-to-Let, the West One Buy-to-Let side of things. Today, we're going to be talking about the buy-to-let market in general. Some of the things that are obviously impacting the market, some of the challenges that the clients, the landlords are going to face, and equally some of the challenges that you'll be facing as brokers going through the current environment that we're in. So the agenda is to give you guys an overview, first and foremost, of ourselves, who we are, what we do, where we sit in the marketplace, and then to give you an idea of the market itself. What does the buy-to-let market actually look like in terms of volumes, landlord profiles, etc. We'll then talk in some detail about some of the factors that are actually affecting the market at the present moment in time. As Nicola's just mentioned there, things like the cost of living crisis, the war in Ukraine, some of the challenges that we see coming forward in the buy-to-let market, certainly this year and probably going forward into 2023 as well. And then we'll talk a little bit about some of the opportunities, because with every cloud, there is a silver lining. So every time we speak about the doom and gloom, there's always an opportunity that's created by that. So we'll touch base on some of those opportunities that will be available going forward, and certainly towards the end of this year. And finally, obviously, how West One can help you to look at those opportunities and obviously exercise some of the deals and the products that we offer will help you to actually engage your landlords in those opportunities that are available. So let's talk about West One first and foremost. Who are we? Well, we've been around since 2005. A lot of you, if you've dealt with us previously, will know us as a bridging and development finance lender, and that's certainly the foundation of the business and where the business first started out. We do like to bring a unique approach to our processes with regards to the products we offer, in the sense that we are very much driven by a manual underwriting process. So no credit scoring in the background, which gives us the ability to look at each deal on its own merits. And we like to give a personalised approach to lending. So even though we have published criteria, there's always an opportunity for us to look at the right case. So if you've got a deal that doesn't quite fit the box or tick the box with regards to the criteria we offer, it's always worth picking up the phone and having a conversation with us, because we do like to judge each case on its own merits. And if it's a good deal overall, we can look at some exceptions to our normal criteria. We sit today as the UK's fastest growing specialist lender. And we're always looking for opportunities to expand, to move into areas that are going to create opportunities for yourselves as brokers, but also for your clients. And that's really partly why we partner up with Knowledge Bank, because their system is absolutely fantastic at giving that kind of information. It's useful to use the system with the Knowledge Bank to understand what each individual lender can offer, and more importantly, where it fits for your clients' needs and circumstances. Now, being the UK's largest growing specialist lender, have we achieved that? Well, our growth has really been achieved primarily through expanding our product range. In January 2017, we launched into the second charge mortgage market for both residential and buy-to-let borrowers. And more importantly, from my side of the fence, we launched our buy-to-let mortgage range in June 2019. Now, initially that went through the packager channel, but during the course of 2021, starting in January, we started to launch that out direct to the broker market through clubs and networks. So as long as you can access a mortgage club or you're a network member, you can access us directly. If you don't fit that category, then there's always an option of going through one of our packager partners to access our products and obviously submit the business through to us. Part of our growth has been supported by delivering bespoke technology, really solutions to the broker market as well, to help you get swift decision-making processes. So to that extent, in the buy-to-let division, we actually have a broker portal, and that broker portal will give you the ability, with some very simple questions to answer, around about 12 to 15 questions, will give you the ability to run a soft footprint credit search at point of sale, generate a decision in principle for your clients, and also the easiest documents that you will need to obviously then have that full and formal conversation with the client. And from that point onwards, everything is then done online. So you can complete the application form, submit documentation to us online, and also have a chat with the underwriter on the case. There is a chat function built into the broker portal where you can actually communicate directly with the underwriter on the deal if you've got any questions or queries around the actual processing of the case at that point in time. Currently, we're, as a group of companies, with regards to second charges, the bridging, development and buy-to-let, we're originating over 1 billion of specialist mortgages per annum. And we've got quite ambitious growth projections going forward to obviously exceed and build on top of that base. Within the EMRA group, my side, my division, West One Buy-to-Let, it's the new name, and it's probably a new name to you guys in the first charge mortgage market. But we are experiencing quite considerable growth within the buy-to-let division, really coupled with the criteria we're offering, the products, and as we said earlier, that unique approach to underwriting on a very manual basis to try and get the deals and the best results for you and your clients. Let's look at the market itself. What does the buy-to-let market actually look like? Well, you'll see on the screen there that it's forecast for this year is to be around about 45 billion last year, should I say. For this year, it's actually forecast to be about 38 billion, which is a slight drop. But that drop is very simply explained by last year having the luxury of the stamp duty holiday, which did grow the buy-to-let market quite considerably as people took advantage of not having to pay any stamp duty for the purchases they did. So we're going to see the market return to a slightly more normal level of around about 38 billion this year. But again, that is growth on top of what we would have expected from the 2020 figures. Part of the growth in that market is really the specialist mortgage lenders. You'll see on the screen there that annual lending within the buy-to-let market has grown by 19% year on year since 2009, driven by the specialist mortgage market. To give you an idea of how big we are now in the specialist space, over 50% of buy-to-let transactions last year were through specialist providers. So partly the buy-to-let market is needing more specialist approach. It's needing more of that manual underwriting scenario that we can offer, where we can take a more pragmatic view at the deals and not have that tick box scenario that you tend to find with the high street lending. In the UK, number of buy-to-let landlords is now at an all-time high, 2.7 million landlords. But an important factor behind that, excuse me, is that of those 2.7 million landlords, 29% of the landlords are holding at least one of their properties within a limited company structure. Just to give you an idea of the scale of the limited company market now in the buy-to-let space, there were 47,400 new buy-to-let companies incorporated in the UK last year, and that's 14% up since 2020. So again, this is really part of the story about why specialist lending is growing quite dramatically in the space. It's because we cater for things like limited companies. And, you know, that's a real mainstay of our business. Certainly in West One, we're probably looking at around about 55 to 60% of our transactions now are through a limited company structure. And that's really what the specialist market is designed to embrace, is the slightly off center, the slightly more quirky deals, the slightly more quirky pieces of criteria. 18.7% of dwellings in England are currently occupied by private renters. But on top of that, 16.7% are occupied by social renters. So looking at the total market in England, you're looking at circa 35% of households on a rental basis. So you can see this is quite a substantial market. And the anticipation, the expectation is that's a market that will continue to grow. 40% of rental properties don't come up to scratch. And this is a really important factor, as Nicola mentioned at the beginning, EPC ratings. So 40% of rental properties currently have an EPC rating of D or lower. Now, you'll see later on in the presentation that could have some serious consequences for the landlord and the rental market going forward, because there are some quite substantial changes coming into that space. The UK government has obviously just actually announced as well that 40% of homes receive a Band C energy rating, which is up from 9% in 2008. So there is a green movement, a need to look at the EPC rating and obviously make sure that your house is as energy efficient as possible, particularly with the rise in the recent energy bills. And the buy-to-let market is obviously going to be embracing that a little bit more fully, and we'll cover that off slightly later on in the presentation. Now let's talk about some of the factors that are actually impacting the market today and probably in the short term as well. The biggest one, and I think we're all sitting in the middle of this, everybody on this call is probably experiencing this as well, is the cost of living crisis. We've got a combination of factors here. You've got rising inflation, you've got the substantial increase in energy costs, with more to come in October, judging by the news at the moment. You've got continuing rate rises coming in from the Bank of England, where there hasn't been movement for 10 years or so. And all of a sudden we're seeing month after month of consecutive Bank of England base rate rises. All of these factors are contributing to the growing cost of living crisis. Millions of people being impacted, and particularly first-time buyers. Rising costs inevitably hit the lower end of the market first. So for first-time buyers, they're going to have a massive impact on their disposable income. So it's obviously going to make it more difficult for them to save for deposit funds. It will also impact the amount lenders are comfortable lending to them, because obviously their cost of living, their utility bills, their grocery bills, etc., will be increasing in the background. So for a lot of first-time buyers now, rental may be the only option available to them, which is why we're expecting to see quite substantial growth still in the buy-to-let market. Look at existing renters. Home ownership plans that they've had, again, saving deposit funds, etc., may be now put on hold or pushed back due to the cost of living crisis. So we're going to expect strong demand in the rental sector to continue for existing tenants because they're forced to rent for longer. So there's some real good opportunities here for the landlord market to explore opportunities to increase their stock, to actually give the facilities for these people to actually have housing. HMO landlords, particularly, that charge their tenants an all-inclusive rate, are obviously going to be affected by the cost of living crisis themselves. So there is some impact on the landlord market, where you're actually doing an all-encompassing rental charge, which includes utility bills. These landlords are going to need to keep an eye on their profit margins, particularly due to the energy price increases. HMO tenants, typically they're students, individuals on low incomes. So passing on the cost of rising bills will put extra pressure on the tenant and potentially see them struggle to meet rent, and again, potentially falling into arrears on the rental side. Part of the specialist market growth that we may see, although I'm hoping this won't be the case, will be the advent of impaired credit again, the slight surge in impaired credit as people do struggle to meet the bills, coupled with the challenges that we all face through COVID. With profit margins hit, landlords that don't already hold their properties in a limited company structure will now need to look at reconsidering this. As you probably are aware, there are some tax benefits of putting your buy-to-let properties into a limited company structure. A number of landlords have already taken advantage of that. And again, as I mentioned earlier, around about 55 to 60% of our transactions in West One are through a limited company structure for this exact reason, to take advantage of the tax benefits of that limited company structure. Last point on the slide is the mortgage rate impact. You guys, I feel for you at the moment because it's an ever-changing landscape, both in the residential market and in my space, in the buy-to-let space, with regards to people changing products, withdrawing products, repricing products. But generically, the prices are going up. Most lenders have put their prices up during the course of this year. Equally, there is quite a lot of volatility in the swap rate market. So the price that we're buying money in to lend out has increased quite dramatically. In January, you were able to buy funds at 0.4, maybe 0.6%. And as of yesterday, it was at 2.2%, which will give you an idea of how much the rates have gone up. And obviously that has a major impact on the lender's profit margins, which has been reflected in the increase in pricing that you're seeing across the market. So there are some real challenges at the moment across the board for clients, for brokers, for landlords and for renters. And let's talk about the real big, oh, sorry, jumped a slide then, apologies. We're talking, one of the real big unforeseen events that's obviously occurred this year is the war in Ukraine. How's that impacted? Well, there was a record annual rise in house prices of 10.8% in 2021. That was reported by Halifax. And confidence in the continued growth of house prices was high for this year. However, the war in Ukraine, when Russia invaded on the 24th of February, is going to have a knock-on effect on property prices. Food and fuel prices that are rising due to the inflation, the bank base rate movements upwards, the attempt to control that inflation, it's all going to have an impact on people's buying power and their desire to move or buy. Current predictions in the market are indicating that the growth of property prices will be significantly slower this year, but we're not expecting to see a drop. One thing that drives the UK housing market is supply and demand, and there is still a massive shortfall of housing stock in the UK. So the expectation is that property prices will maintain. They probably won't grow substantially over the course of 2022 and maybe into 2023, but we shouldn't see any falls. And the confidence in those factors is relatively high in the market at the moment. Now, whilst that isn't necessarily bad news for landlords, it could have an impact on portfolio landlords who are looking to finance new investments. And generically, your portfolio landlords tend to go into the equity on their current portfolio to fund their additional purchases. And clearly, if there's limited growth in the market value of their properties, there's going to be a restriction on the number of equity or the amount of equity they can draw out of their current portfolio. With a move away from Russian oil driving up the cost of fuel, one of the key things you're going to see is the cost of air travel likely to surge. So COVID restrictions, the barriers are coming down as we speak. And there has been a staycation boom in the UK, which we will speak about shortly in the presentation. But there may be now a return back to staycation. There was a danger the staycation bubble may burst because the COVID restrictions were relaxed, but we may actually be seeing a tide turn again back to staycation, because although international borders have opened up, is it financially viable now to fly abroad with the cost of fuel rising being inevitably passed on through the cost of the holidays? So we're looking at strengthening demand for specialist lending. We're looking at specialist buy-to-let opportunities that are growing exponentially in the market at the moment, particularly in the holiday let and short-term letting market. So let's talk about the other issue that we've all been facing over the last couple of years, COVID, which hasn't been a pleasant experience for any of us. I'm certain that we can all agree on that. What's been the impact on the buy-to-let market? Well, very much in the early days of the pandemic, the move to home working, and again, the comfort of working from home, there was quite a large exodus of people working and businesses from urban areas, particularly big cities like London, Manchester, Liverpool, these kind of areas. People were looking for opportunities to not have to keep buying and paying for expensive office space in the city. So again, we've seen a number of businesses move out of city. So the challenge for the buy-to-let market was that a lot of buy-to-let property was in the central city areas and used by people that didn't want to have a particularly long commute. But if those people have now moved out of those areas, you've got an awful lot of buy-to-let properties that were vacated during the course of COVID. But thankfully, we're now out of COVID, or certainly we're out of the what seems to be the worst situation within the COVID environment. So 2 years down the line, people are now starting to return to the offices. People are starting to return to the buzz of city life. And hopefully, we're going to start to see a growth again of buy-to-let business within the cities. There is an increase in demand for city living, without a doubt, and we've certainly seen that over the last 6 months. And that's really good news for landlords with the city-based properties. As well as tenants that are moving back to cities like London, there's been a marked increase in inquiries from expats and foreign nationals looking for buy-to-let mortgages. Knowledge Bank, and obviously Nicola and her team provided us with some of this information, reported a 16% increase in searches from 2020 to 2021 for expat and foreign national mortgages. So the foreign market, unfortunately, when the world went into lockdown in March 2020, it was really hit. The buy-to-let market particularly was really hit by the lack of appetite for foreign property investors and expats who were obviously unable to travel, unable to come to the UK to view properties or to look at their existing stock. They just started not to buy property in the UK. But what we are now seeing is definitely transactions in London, the cities, and some of the outlying areas are once again rising. Value of the properties in the capital are rising still. So it's still a great investment opportunity for foreign nationals and expats to invest in property in this country. And thankfully, our government's light touch approach to COVID and its rapid response to obviously opening up the borders again, it's really starting to appeal again to foreign nationals and expats to return to the country and start buying UK stock, UK investment properties to add to their portfolio. And again, a real area that is the specialist of the specialist lenders in the buy-to-let market. Rising house prices, interest rates, the increase in cost of living are expected to take their toll, and the number of people cautious about taking out a mortgage or increasing their indebtedness is expected. Expat investors who are not paid in sterling, as we've just mentioned, are not likely to be affected so hardly or so harshly by these changes and by these factors in our market, because they're not paid in sterling. And certainly at the moment, anyone that's going on holiday or is looking to go on holiday will have this experience of how weak the pound is at the moment. which is great for a foreign investor, again, looking to actually buy in the UK, because they'll have a bit more buying power, a bit more bang for the buck with regards to the currency they're currently paid in. So is this a market that you've considered? Is this a market that you're active in? Is this something that you can look at or look to expand your business into, foreign nationals, expat investors in the UK? Because trust me, the transaction itself is as straightforward for a specialist lender as it is doing a UK-based citizen in this country. We may ask a few extra diligence questions, but overall, the transaction itself is a relatively straightforward one for the specialist market. Now, we've mentioned this a couple of times. Just lost my arrow, sorry. EPC regulations. So this, without a doubt, is the largest impact that's coming to the buy-to-let market. It's the change of requirements on EPC, energy performance certificates for rental properties. The current EPC regulations are relatively straightforward. They were introduced by the government in 2018 with the intention of improving the quality of private rented buildings. Now, since 2018, a minimum EPC rating of E has been in place for all new properties, all new tenanted properties. So if you were buying a property today and the intention is for it to be let out, then obviously you'd have to get an EPC rating of E on that property for it to qualify, and all lenders would look at it from that point of view. And there are very few that would lend where the situation isn't an E rating. Certainly in West One, we do an awful lot of bridging deals where you are able to buy an EPC rated property under E, do the necessary works through the bridging finance to bring it up to scratch, and then we would step in with the buy-to-let refinance to remove you from the bridging. Now, landlords at the moment, if you don't have a valid EPC certificate on your rental property, you can get fined up to £5,000. But let's talk about what's coming. So this is the proposal. From the 1st of April 2025, landlords of newly tenanted properties will need a valid EPC rating of C or above, which is quite a jump from E to C. And equally, from the 1st of April 2028, so a little bit more time, for existing tenancies. So this is for existing rented properties, not newly rented properties. For existing rented properties, they're going to need that EPC rating of C or above from April 2028. So from April 2025, it's for the new buy-to-let properties. And from April 2028, it's for the existing let-out properties, going up to a C or above. And the fine for not having that valid EPC certificate in place is going to rise from £5,000 to £30,000. So quite considerable changes. So this is going to have an impact on the landlords. It's going to create a number of challenges for landlords. Number one, how do they finance the work? Number two, do they own properties? We're looking at things like Victorian properties, detached, semi-detached, listed buildings, that kind of situation where the upgrades may not be available. So what do they do with those types of properties? Because they won't be able to rent them out any longer. So they're going to have to dispose of them in the market. We've got an issue at the moment with regards the availability and quality of the builders and tradespeople available to actually do the upgrade work required. So there may be time pressure. People need to really be thinking about doing this now so they're not caught foul of the change in laws in 2025, 2028. Now, with regards to that, there is unfortunately a short time to prepare for these changes, but it's really part of the conversations that you need to be having with your landlord clients now with regards to what is the EPC rating of the property now and what do they need to do to bring it up to scratch before these changes come into place. Now, interestingly, with the conversations that are happening in the market already, would you believe that 35% of landlords have stated that they would rather sell their sub-C rated property than finance the upgrades? So there's some economics behind that. If you're a relatively low-key, what we would call unprofessional landlord that's got one or two properties in their portfolio, and all of a sudden you've got a 20, maybe £30,000 bill to change all the windows, cavity wall insulation, lag the loft, all these kind of things that you'd have to do to raise the EPC rating, you may actually think to yourself, it's just not worth doing it. I won't get the return from the buy-to-let property over the term that I was intending to hold it to actually offset the cost of changing that property and getting the EPC rating up. So that's something to bear in mind. And also, as of the changes in 2025 that are coming, properties without a valid EPC certificate cannot be legally let. So you'll find the lending market will just not be in a position any longer to let or to lend on a property that is EPC C or below, effective from 2025. So some changes really need to be put into action straight away. So as mentioned earlier, this is probably the biggest challenge that the buy-to-let market faces, but also a great opportunity to look at specialist lending, different ways of financing the works, different ways of buying the property and bringing it up to scratch now to make sure that the landlords aren't falling foul of any of the potential penalties down the line. And that's really what we want to talk about now, is the opportunities that all of these things create. It is, as I said at the beginning, every cloud has a silver lining. So all these changes, all these things that are happening, the cost of living crisis, the Ukraine war, EPC rating changes, etc., will create opportunities for the right brokers and for the right clients. The biggest opportunity that we see, and we're already seeing it growing in status within our product portfolio and certainly within our submissions, is HMOs. HMO property does have strong long-term prospects for capital appreciation, because as we mentioned before, an awful lot of the first-time buyer market is going to need to look for a rental solution rather than a house buying solution in the short term. And HMOs tend to be student-let properties, first-time out-of-house properties. So people that are looking to leave the family home for the first time will tend to gravitate towards a HMO property, because it's a great way to get your foot on the housing ladder, or the rental ladder, should I say, but also at a reduced price, because obviously you're splitting the rent amongst a number of people within the same property. From the landlord's perspective, this property is an absolutely ideal opportunity to get a property that will have increased rental yields, because you're able to rent it out on a room by room basis, as opposed to one rental covering the entire property on a standard AST agreement. And the yields and the rental value of a HMO is normally considerably more than letting it out on a standard AST basis. The situation is, as I've mentioned, there's going to be an increase for the demand of this type of property, cost of living crisis, lack of ability for those first-time buyers to get on the ladder. And the HMO just offers that more economic way to rent and actually get out of the family house and go and explore the world for the first time on your own. Easing of lockdown, COVID restrictions means communal housing situations are now more readily acceptable. It's more acceptable now to live with people in a property than it was when COVID was in full flight. But there are some challenges in the HMO world, and that's around the licensing. If you didn't know, the government's ruling around HMO licensing is that any property that is occupied by 3 unrelated people can now be classified as a HMO. You do need to check with the local authority because they do have varying licensing conditions, and each one has its own take on what they believe is a HMO and what isn't. And certainly if you're looking at Article 4 areas, in an Article 4 area now, you cannot now convert a standard residential property into a HMO through permitted development rights. You do need to get planning permission for that alteration to take place. But equally, there's a fantastic opportunity there, because the value of existing HMO stock is increasing, because the challenges around licensing, the challenging of converting existing properties means if you can just take one off the shelf ready package with the license in place, the planning permission already done, the conversion already done, it adds an extra bit of value to that property. So again, for existing HMOs out in the marketplace, existing landlords that own them, there should be a spike in the equity increases in those above and beyond the stability of the other house price rises in the market at the moment. And the tax changes that have been present in the buy-to-let market since the announcement of the Osborne budget in 2016, which is when all the tax changes were announced. And obviously you can no longer offset mortgage interest on your annual returns for the tax purposes. You need to look at better profit margins. You need to look at properties that are going to generate a greater yield. And clearly, a HMO represents the greatest opportunity in the market at the moment to increase the yields and increase the profitability for the landlord. Now, alongside HMO properties, there is another opportunity in the market, and that's MUFBs, multi-unit freehold blocks, for those who weren't familiar of the terminology. What this is multiple flats normally that sit on one freehold title. So the lender will take a charge over the freehold of the block with individual units within that, but the lender itself's charge will only be over the freehold and not over the individual units. Now, these are really growing in popularity as well. Now, from my side, West One, we're getting an awful lot of property developers going into the multi-unit block scenario. It creates an opportunity to create multiple flats within one title. And then you don't have to go through the process of or the cost of splitting titles, creating leases, because you know you've got a lender out there that will actually just take a charge over the entire freehold of the block. And equally, if you're a landlord and you're obviously looking to retain the properties within your own portfolio and you have no intention to sell them off in the future, it's just a very economic way of doing it. Multiple units available for rent in one block also reduces the impact of rental void periods. You've got the situation where you may have a block containing 6 flats, all on one mortgage. So if one of those flats isn't rented out, but the other 5 are, normally you'll tend to find that the profit and the yields that are generated on those 5 flats will be sufficient to cover the void in flat number 6. So it gives the landlord the extra confidence, the extra layer of protection that they're probably looking for with regards to volatility in the rental market, if that is the case in the area that they've actually got the buy-to-let properties at the present moment in time. And again, with a housing shortage, there's a strong demand for housing of this nature. So you tend to find that planning permission is a little bit easier to get through on blocks, flats, units, than it is on building houses, etc. So again, for a developer, property developer, you can maximize the return on the build and you can get a bigger bang for your buck. You can obviously create more return on the same square footage of land, more property on the same square footage of land than you could do if you just bought a single unit house. Now, MUFBs, again, as an advantage above and beyond HMOs, don't actually require any form of licensing in the current market. So there's a slight cost reduction in having MUFBs. And also a bit of an easier process that you can just literally buy a multi-unit block without having to worry about the lenders having a concern about licensing or any restrictions in the background. The only caveat I would put on that is that very often with the lending market, even in my space and the specialist lending space, the one requirement of a multi-unit freehold block is that each of the units has its own separate entrance. Some of the lenders in my space will also demand that each individual unit has its own separate utility supply. I'm not one of those. With West One, we're happy to have a block of flats, a block of units, as long as they've got their own separate entrances, sharing a utility supply. So that's certainly something we can look at for you. Now, I've mentioned it a couple of times in the presentation so far, but a really big opportunity that we're seeing in the market at the moment is holiday lets. The staycation boom, as I mentioned earlier, seems to show little signs of abating. And just to give you some ideas about why I can be confident about that statement, is bookings in the UK today, staycation bookings, holidays in the UK, currently are still above pre-pandemic levels. So what you tended to find was that with COVID, people actually couldn't go abroad. So they decided to holiday in the UK, something we probably don't do, and we certainly don't do enough of, is explore your own country. Now people have got the bug for that and the appetite for doing that. You're tending to find that people are sticking to their guns and wanting to holiday in the UK. And certainly it makes sense for certain sections of the market, because we've now adapted to working from home due to COVID. So you can now go on holiday and still be available to work and still be available at your office, but it'd be in a nicer location if you desire. Equally, when you look at what COVID caused, people are reluctant to now travel abroad because they're concerned about a risk of another COVID outbreak and getting stuck abroad. We've got the ever increasing green agenda that's sitting on the table now, that, you know, does it make sense to jump on a fuel guzzling plane and fly abroad when you can equally have a comfortable and enjoyable holiday on your own doorstep? Cost of living crisis, as I mentioned earlier, the rising fuel costs means that that's going to be passed on at some point, no doubt, through the holidays. It's going to be more expensive to fly abroad. So sometimes a holiday at home can be more appealing than venturing abroad. It can be more financially beneficial to stay at home and take your holiday at home rather than go abroad. Just to again back that up, with foreign travel now fully open across the world to some degree, 9 out of 10 customers, UK holiday makers, still maintain they enjoy discovering a new part of the UK during their holiday. And the report that was done by Mintel's report on domestic tourism in 2021 found that half of holiday makers were interested in renting a cottage for future trips, compared with 25% have done so in the last 3 years. So you can see that we're really starting to get a real growth in the staycation market, a real opportunity that, if you've not explored it before, again, is a very simple world to get involved in through the specialist lending market. There are some real benefits as well for the landlord to owning a holiday let. First and foremost, the cost of furnishing a holiday let can be deducted from pre-tax profits. So there's immediately some tax benefits of looking at holiday let rentals above and beyond AST rentals. Self-catering accommodation, which is the preserve of the holiday let market. is subject to business rate property tax, which allows an investor to claim small business rate relief instead of paying council tax. So again, some small tax savings by doing the holiday let scenario. If an investor decides to sell their holiday let property, they're going to be able to claim certain capital gains tax reliefs, including entrepreneurs relief, business asset rollover relief, gift holdover relief, things that you wouldn't get for selling a standard AST rented buy-to-let property. Income generated from holiday rental is also classed as relevant earnings, which means you can make contributions towards your pension and again, reduce your income tax bill. So I'm not a tax advisor. I'm certainly you guys aren't tax advisors, but there is some real tax benefits to looking at the holiday let market. And it's something to mention to your landlord clients that, you know, they should really sit down with a tax advisor and see the benefits of looking at going into a holiday let scenario as opposed to doing an AST rental. Another key thing with a holiday let is married couples can still divide the profits from a furnished holiday let however they choose, regardless of the ownership split. So there's a nice little quirk with the holiday let market that you may not have been aware of. So if you've got a higher rate taxpayer and a lower rate taxpayer, you could potentially put 99% of the earnings from the holiday let into the lower rate taxpayers bracket rather than the higher rate taxpayer, regardless of the ownership of that property. And again, the real driving factor of the holiday let market is the higher profit margins. With a holiday let, you're looking at daily, maybe weekly rentals as opposed to 6 monthly rentals. And generically speaking, you're looking at 2, maybe 3 times the rental margins on a holiday let that you would do on a standard traditional buy-to-let property. So there's real appeal at the market at the moment for looking at these types of properties for the rental yields, for the income, for the profitability that they'll actually generate from the landlords, coupled with the potential tax savings that you'll see by doing the holiday let kind of scenarios. So hopefully that's given you a few ideas about some of the opportunities in the market, but how can obviously West One help you to service these kind of opportunities? Well, in our current product range, we tend to offer 2 tiers of products. We do standard products and specialists. The defining factor between the two is for your standard products, you're looking at your standard vanilla landlords buying what we would class as a vanilla buy-to-let property, leafy residential suburb rented out to a private family on a 6-month AST agreement. On that, we can look at limited company deals. We can also look at first-time landlords. A real key thing with West One is we offer first-time landlords facilities across our entire product range, with the exception of the expat and foreign national products. Foreign nationals and expats would have to have an existing buy-to-let in the UK to qualify for a deal with West One. We just want to see they've got a track record of rental in the UK and the ability to service a property remotely from abroad. So just bear that in mind, that first-time landlords, we're happy to take those on board for HMOs, multi-unit blocks, holiday lets, flats above commercial, all the kind of stuff you'd expect from a specialist lender. But for expats and foreign nationals, you have to be an existing buy-to-let holder in the UK for us to actually look at that deal. On the other side, we have the specialist deals, which, as I've just mentioned, is all your more quirky types of properties, your HMOs, your MUFBs, your expat deals, your holiday lets, all that kind of stuff. But again, we're more than happy to cater for those. And one real thing that we are really, really keen to engage with you guys on is portfolios. We really do have a very strong portfolio offering. We can lend up to £10 million to an individual on a portfolio deal. But more importantly, they can have an unlimited portfolio in the background, and we do not stress test the background portfolio. We will sense check the background portfolio. So we want to see that the current rent generated from those properties covers the current mortgage payment, but no more than that. So there's no artificial 5.5% rate applied to that. It's just literally seeing the rent covers the current mortgage payment. And as long as that is the case, then we're comfortable to go and do another 10 million for that client on top of their existing portfolio. In addition, we're quite keen on large loans. So as a lender, we will do a £2 million loan on a single asset up to 75% loan to value. And if you want to cross over the 75% mark and across over the £2 million mark, we can actually do up to 4 million at 65% loan to value. So again, single asset lending, loans against a single property, we are quite keen to look at the higher loan margins and the bigger deals for you guys if you have the opportunity to get some of those landlords and properties across the line. Some useful criteria with regards to our product range. Minimum term for us is 5 years, maximum term is 25 years. Minimum age application is 21. and maximum age at application is 80. So we can look at an 80-year-old applying for a mortgage with us on a buy-to-let basis. We would more than likely cap the term on an 80-year-old deal to their 95th birthday. So bear that in mind, that as they're in that increased age bracket, probably 95 is our upper limit with regards to age at end of term on the mortgage, but we will accept an 80-year-old at point of application. We have no minimum income requirements. Now, very much like many of my counterparts in the market that say they have no minimum income requirements, we still require the client to state an income on the application form. And that income must be sufficient to cover the client's lifestyle. So we would expect them to be able to demonstrate an income that is able to cover their current expenditure and their current lifestyle. However, what I can promise you is that if the overall deal fits on our higher rate tax threshold, now our higher rate tax rental calculation and additional rate tax calculation is 140%, 140, not 145, 140 at pay rate on any of our 5-year deals, or an assumed rate of 5% on our 2-year fixes or lifetime trackers. So immediately, I am giving you more bang for your buck because I can actually do a more flexible rental calculation than a number of my peer group to give you a little bit more lending capacity from the same rental. But that is the only situation where I would actually ask the client to prove income is if they are a basic rate taxpayer. So if they state to us that they are a basic rate taxpayer, and the deal needs to fit on our basic rate tax threshold of 125%, again at pay rate on the 5-year deals, or 5% on anything else, that's when we would ask for evidence of income so we can actually ascertain they are a basic rate taxpayer. So if the overall deal fits at the higher rate tax threshold, we would not be asking you for evidence of income. Obviously, first-time landlords, as we've discussed across the product range, with the exception of the expats and the foreign nationals, we'll accept family gifted deposits. So blood relatives can either gift cash, bank of mum and dad situation to help with the purchase transaction, or if you're buying a property from a family member, then obviously they can give an unlimited equity gift, and then we can lend the balance up to that 75, maybe 80% loan to value that we offer on our current product range. We do regulated consumer buy-to-let mortgages across the product range. Key thing to note there is we do offer a true let to buy scenario as well. So if you've got a client living in their current residential property, looking to move out and let out their current residential property on a buy-to-let mortgage, provided we get simultaneous completion with their onward residential purchase, we will happily do that let to buy scenario for you. So some other high level stuff, which we've probably covered off in a bit of detail. You see there the portfolio lending thresholds. You've got leasehold block exposure as well. This is a real key thing for us. A lot of the lenders in the market will look at 4 units, 20% of any block before they will actually step away. And that may be with other lenders as well. It may be just the exposure of the individual landlord to that block. You'll see there that we are more than comfortable to do a leasehold block exposure of up to 20 units, and we'll do 100% exposure against those 20 units. So if you ever get a situation where you have a landlord that owns a number of units in one block, that's certainly something that we have an appetite for. Just bear in mind that if you get, or we're looking to be asked to lend against 5 or more properties in a block, there is an opportunity that the valuer may recommend a block discount of maybe 10, 15% against the value of the unit. So that's something we can discuss with you at that point. So if you get any of those types of deals, just give us a call and we can obviously chat through. We have obviously great turnaround times. Our service is exceptional at the moment. We basically will look at any documentation within 48 hours of receipt. And at the moment, we're looking at 2, maybe 3 weeks for application to offer scenarios, subject to obviously valuation taking place within a reasonable amount of time and the client providing the information we request when we request it. Mentioned at the beginning, we do assess each case on its own merits. So our criteria is there as broad brushstrokes. We can obviously look at things outside of criteria on a referral basis. So use Knowledge Bank to obviously take a look at what we offer, what we do. But if you have something that's slightly out of the norm with regards to the criteria that's published, always worth a conversation with us because we can look at each case on its own merit. We don't need any buy-to-let experience. As I mentioned before, we will look at a first-time landlord, but we won't look at a first-time buyer, first-time landlord. So they do need to have a property in the background for us to be able to take them on board, but you don't need any buy-to-let experience on that basis. We don't credit score. We have no minimum income requirements. We do limited companies across every product, including holiday lets, expats, foreign nationals, all that kind of situation without any rate loading. We can look at large HMOs, large MUFBs, 10 bedrooms plus, And again, if you've got something over 10 bedrooms, give us a call. We'll happily take a look at it. And holiday lets, just a key thing at the bottom there, holiday lets based on AST rental value. That's a protection governance for us and also for the client, because if they do take on board a holiday let property and for whatever reason it no longer becomes viable to keep letting that out on a holiday let basis, maybe the area that they bought that property in is no longer a popular holiday destination, we will always assess it on AST rental value. So the client's always got the comfort of knowing as a fallback position that the AST rental that property will generate will be enough to cover the mortgage payments going forward. So they can just then flip the holiday let into a standard AST rental. That's really it from me with regards to the presentation. So it's over to you guys now to see if we've got any questions.
Fantastic. Thanks, Paul. That was amazing. I learned so much on there, and never mind the brokers. That was such a good presentation. And I can see from the comments that lots of questions on the back of it. So if you don't mind, shall we jump into those?
Yeah, please do. Yeah, I can't see it on my screen, Nicola. It's all disappeared for some bizarre reason.
No worries. Don't worry. I've got you. I've got the questions. So, right. Okay. So first of all, I want to just rewind back to the EPC changes, because yes. Safa says, wow, that's big news. Is it definite? As somebody else has asked, this is big news about EPC changing in 2025. Is this definite or possible to change? What do you know about that at the minute, Paul?
At the moment, it's government legislation, so it's coming into force, unfortunately, in 2025. Will it be stopped? Unlikely. With the green agenda that we have in the country at the moment, and the need to make properties more energy efficient, even more pressing now with the energy price bills, I cannot see it changing. I cannot see the government backtracking on it. So unfortunately, yes, as part of the presentation, it's brace for impact, and it's an opportunity for you guys to reconnect with your clients, your landlords, have that conversation. They may not even be aware it's coming, is the honest truth, and then look at their options and potentially some financing options for them to actually help them facilitate the works that will be required to bring the properties up to scratch.
Yeah, absolutely. I think one of the big things about that, and we did a criteria clinic a couple of weeks ago on green mortgages, and we were talking about this as part of green mortgages and saying, actually, you know what? If brokers don't have this conversation with landlords, who's going to have it? It's such an important role, isn't it? You know, and these changes are coming in. I know there are. Correct me if I'm right, Paul, because you'll know a lot more about this than I will, but there are some things coming in, aren't there, where I'm not sure what it stands for, but the SAP, SAP compared to EPCs, because they're also looking realistically that the government have to look at what they can do with properties that just, the technology is not there to make them an A, B or C rating on EPCs. You know, so you've got all these old properties, the old 2 up, 2 downs, the single skin walls and all of that you can't put cavity wall insulation into a single skin. So, you know, what we're going to do with those. So there is, I believe, some consultation going on around that, in that if you've spent so much on the property, I think, is it 3,000 up to 3,500, if you can prove what you've done to increase it and try and help. Is that, can you shed any light on that, Paul?
To be honest, Nicola, you know an awful lot, so well done. Yeah, you're absolutely right. So it is under consultation at the present moment in time, and we mentioned it in the presentation that, you know, listed buildings that fall under that category. You know, there are buildings in the UK at the moment you wouldn't be allowed to change the windows on. Yes. You wouldn't be able to change the cavity wall insulation, as you've mentioned. So the government is under consultation on that at the moment as to what they can do to actually accommodate those properties. And obviously from the lending side, we're very keen to hear what those measures are, because right now the criteria is, if you're not EPCC, we don't lend to you. So there will be some, unfortunately at the moment with the government's current legislation, some properties that will not be able to be brought up to that standard. So that's why they're in consultation at the moment as to how they can address that issue.
Yeah, absolutely. And you know, and we will keep you informed of that as well. I mean, we have got another green mortgages criteria clinic coming up later in the year. We'll look at the changes, and as always, we'll try and keep you informed on what's going on our emails that we send out. So other questions then. So Richard asks, do you guys offer product transfers for limited company borrowers?
What I would say to you at the moment, Richard, great question, is today, no, but yes. On the basis that if someone comes to me, the likelihood is they're going to be on a 2-year term minimum. 5-year term is the norm. We're doing around about 86% of our business on a 5-year deal. Obviously, people are now locking in on longer term fixes because of the rate volatility. we are in the process at the moment of looking at both a product transfer and a further advance option on our products. As we're new to the market, we've only been literally in the broker market for a year, 18 months now. It wasn't a high priority, but clearly it's become a high priority for us. So yes, I would say to you that if you put an application to us today, the likelihood is very strong that we'd have a product transfer option for that client at the end of the deal. Now, the next question you're going to ask me is how would that be interacted? Well, I am a broker-driven organization. I cannot deal with clients direct. So the beauty that you have is that we would approach the broker that introduced the original deal to us to discuss the product transfer with the client. It wouldn't be anything that we would do direct with the client.
And that is music to any broker's ears. I know as an
Indeed.
absolutely, you know, you do a lot to look after your clients and give the best advice. So, you know, lenders that work in conjunction with that is it's always preferable from a broker's perspective. Absolutely. Right. Okay. More questions. Richard asks, so regarding multi-unit freehold blocks, 2 flats above a retail shop already let, is that okay?
Yeah, so we have a flats above commercial criteria. Now, in essence, what we look at, and I'm going to use some industry terminology here, so please forgive me. If your flat is above a smelly, smelly being fast food, dry cleaners, hairdressers, that kind of situation, we would probably be looking at 65% loan to value. But if your flat was above a supermarket, 70%. If your flat was above a estate agents, accountants, solicitors, 75%. So the key thing that West One can offer you guys, all brokers, is that we have internal RICS surveyors as part of our actual staff. So if you get something like a flat above commercial and you just want a sense check of our appetite, what would we look to lend on that type of deal? We've got immediate access to RICS qualified surveyors who can say, you know what, that is above a estate agency in a beautiful part of town, 75% all day long. Vice versa, they might turn around and say, that's a flat above a kebab shop, 65% all day long. So we can give you a very quick sense check, no cost to you, no cost to the client. The only thing that will cost you is time for us to get the response back to the from the internal valuers. They have a 24-hour SLA, so we would know within 24 hours what our appetite would be for any flat above any form of commercial.
That's fantastic, because that it's not just the time saving, it's the money saving aspect as well. And so that is so valuable to be able to do a pre-check on a property. And of course the valuers know the areas, they've got, you know, Google Maps and Street View and all of that, haven't they? So that's a really, really useful thing. Thanks, Paul. Right, a couple of questions from Glenn. So Glenn says, hi Paul, do you class holiday let the same as properties let via Airbnb? That is a great question.
Fantastic question, Glenn. Superb. And thank you for raising it, because I forgot to mention it. Our holiday let product is slightly misnamed in the sense that it should be called a short-term let product, because we will let on any short-term basis, including Airbnb. So if you're renting it out nightly, daily, weekly, fortnightly, monthly, we can accept that on our holiday let stroke short-term let product. So Airbnb is not an issue for us at all.
Fantastic, because I know that's just so popular, isn't it? Airbnb and you know, if anyone is putting a holiday let out, they quite often do both, don't they, at the same time?
Just a caveat though, with that one, Glenn, just remember that we will assess it on an AST basis, and we would expect the valuer to comment that the property has appeal for AST rental. So with our holiday let offering, very much like all the lenders in the specialist space, we wouldn't lend where there are holiday let restrictions. So be wary. Obviously check with the client. There's nothing in terms of onerous covenants on the title of the property, such as you can only let it out for 11 months of 12 and it's only available for holiday letting. That's something we wouldn't lend on. We want it to appeal to AST rental. Fair
enough. That sounds sensible. So Glenn's also asking, does West One do corporate lets? And if so, can you do 2 properties on one application? Plus, what's the minimum stroke maximum term of tenancy?
Great question again, Glenn. You should come to all our presentations. So with regards to corporate let, yeah, we have a full-blown corporate let offering. So there are some caveats around our corporate let offering. The corporate lease agreement between the landlord and the company renting the property can be no longer than 5 years in length. We must have a landlord break clause built into the contract as well. Now, that landlord break clause is commonly no step-in rights. So from a lender's perspective, looking at the worst case scenario, if anything goes wrong, and we have to step in and take the property, we want to be able to action a clause in the contract that states that we can then give notice to the tenants to remove the tenant. So that landlord break clause must be in the contract from inception and must have a 6 months notice period in place. Now, with regards to your other question, Glenn, To properties, we don't do what we call true portfolio lending, cross-charging against multiple properties. So if you've got a number of properties that you want to present to us for one client, we would treat them as individual mortgages. So each property would have its own individual deal. However, we do, because we are very keen on the portfolio situation, have the facilities in-house that if you sign up the first deal for us and complete the first deal on our portal, we will then do all the rest for you. So if you bring me a portfolio of 15 properties, for argument's sake, all we would ask you to do is key on the first property, the first client's details onto our broker portal, and then give us the property details for the rest, and we will do everything else for you. So you'd only have to be involved in that first application.
Fabulous. That's making it even easier, isn't it?
Yeah. And again, the reason we've gone down that road is the cross-charging scenario works for some, but for the majority it doesn't, because when you cross-charge against multiple properties, it does prevent the client from selling those properties in the future, because you then have to release the lender's charge over the entire bulk of properties just to release that one property. And we have seen it in the past that lenders can then play hard and fast with the sale proceeds from that property and how much they want paid off their mortgage balance. So we've just got away from that situation by just saying, let's just treat every single property as individual. So therefore you've got the option to liquidate whatever properties you want without having to worry about West One's charge.
Yeah, no, absolutely fantastic. Thank you. I'm conscious of time. I just want to try and get through as many questions as we can, because there's some absolutely super questions. Femi's asked a question: can you accept a foreign national remortgaging a property that they own already in the UK as a buy-to-let? The value is £300,000.
All day long. The only caveat with that is I would expect that buy-to-let to have been rented for at least 12 months, and I need to have an active UK credit profile. So fingers crossed they've got it mortgaged, there's an active UK credit profile, and then we will do that all day long. Now, Femi, just to note, though, that the slight difference between an expat and a foreign national application. For an expat, I can lend to an individual or a limited company. For a foreign national, specifically foreign national, it has to be, the lending entity must be a UK-based SPV. So I can't lend to the individual. It must be a UK-based SPV for me to do that transaction.
Fantastic. Thank you. And then Shane wants to know, do you accept a gifted deposit from parents on a limited company purchase and then repaid via a director's loan?
No. So you can't gift to a limited company, unfortunately. So the only way around that would be the parents become party to the limited company. So for us, the only people that need to be named on a limited company application are any directors or any shareholders with 20% or higher shareholding. So if the parents want to become 1% shareholders of the limited company, they could then be named as on the application and just provide the deposit as directors' loans, for argument's sake, or internal company borrowing. And then we could look at it that way. But if they're doing it externally, we wouldn't accept parents gifting to a limited company.
Brilliant. Can I squeeze, we are literally on the deadline. Can I say, I've got one more question. Can I squeeze it in?
Yes.
Is that all right? Fantastic. So Gillian wants to know, going back to EPCs, if you have an existing rental property and the tenant changes after the 25th of April, do the new EPC rules apply, or will it kick in 2028? And therefore the April 25th deadline is only applicable to properties that have never been let out before?
Yes, absolutely. So 2025 only applies to properties that have not been previously let. So they are new tenancies. If the property has been let before for any length of time, is our understanding, then you kick into the 2028 scenario. So the key thing is get it rented out before April 2025.
Quick as you can.
Yeah.
We've literally just hit that deadline. Paul, thank you so much for that. Clear from the chat comments that I wasn't on my own in thinking that presentation was fantastic. Glenn's also said he agrees, probably the best presentation I've seen for a while. So that's absolutely fantastic.
Thank you, Glenn. Much appreciated.
Such good information on there. Paul, what do we need to do then? So brokers, if they're not registered with you and they want to get registered, or they want to chat with somebody further on what they've seen this morning, what do we need to do?
Key thing is just jump on our website, everyone. So you go onto our website, go into the buy-to-let section, and in the top right-hand corner, it's register as an introducer. We can then get you set up on our broker portals, and obviously all the contact details are on the website, including our product guide, so you can get a really terrible photo of me with my telephone number. So if I can help you or answer any other questions at all, just drop me a line.
Absolutely fantastic. Can't thank you enough, Paul, for your time this afternoon. It's been so informative and educational. We've covered so much as well in that short space of time. So thanks to everybody who's joined us. I'm sure you found that as helpful as I did, as a few of you have mentioned already in the chat. So hop onto West One's website. Having said that, we will send you out an email with your CPD on, and on that will be all the contact details as well. So you can just click the link as well. So thank you for all your lovely comments, and we'll look forward to seeing you next time. Thanks, Paul.
Thanks, Nicola. Much appreciated. Thank you.
Thanks, everyone. Have a great rest of your day.